Good morning and welcome to this Wednesday, July 22nd, 2020 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, last look, futures kind of mixed this morning. Overseas, things were mixed in Asia overnight, and then this morning, Germany was definitely down, along with other European countries. And so we'll see whether or not that carries over. But overnight, Asia saw a pretty sizable drop in Hong Kong, down 577 points. The Nikkei down 132 points, which was about 0.5%. Hong Kong was 2.25%. And then looking at Europe this morning, we see the DAX. And I follow the DAX pretty closely because of the strong positive correlation between the DAX and the US, but right now the DAX down about 0.5%. So I'm not too surprised that we're seeing futures down a little bit. Dow Jones futures down 30 points, S&P down 4. We have broken out on the S&P 500, clearing that June high, which was around 32.32. And so we're about 15 points above that. So pulling back to that 32.32 level on the S&P wouldn't be that big a deal. We'll see, whether or not we can hold there. NASDAQ futures are slightly higher. The bifurcation in the market continues, though. A couple days ago, we saw the NASDAQ having a huge day while the Dow went nowhere. And then yesterday, we actually saw the opposite. We saw the Dow Jones up 160 points, and the NASDAQ was down 87. So, we're flipping and flopping. It seems like every day it's a little different curveball that the market's trying to throw at us. But we're going to get into all that in just a few minutes. I do want to just point everybody to our website over at earningsbeats.com. If you haven't checked this out, please make sure you do. At our homepage, we've got a free Earnings Beats Digest newsletter. Gets delivered Mondays, Wednesdays, and Fridays in the morning, usually right before the market opens or just after. All you have to do, type in your name, email address, hit the subscribe button. You can unsubscribe at any time, no credit card, completely free. But it gives you a good sense, I think, as to how we trade the market, the way we look at things, how we try to approach our trading strategy and how we develop our trading strategy. I think all of those clues are communicated in our free Earnings Beats Digest newsletter 3 times a week. So go on over to Earnings Beats if you're not already a member and sign up. We'd love to have you as part of our community, growing community, and for good reason. You can see over on the right-hand side our portfolio performance, which has been outstanding. If you'd like to try our service, our paid service, you can click on the Join Today button, get some more information, and sign up. I will say, though, if you look at these portfolios and the performance that they have, generated since their inceptions, they've been remarkable. Our next selection will be August 19th, which is less than 30 days from now. So if you sign up for a 30-day trial, which is essentially free, it's a $7 trial, but we refund you within a week and a half. So your net cost is $0. But if you try us out now, your 30 days will carry you over that top 10 stocks webinar, where I will be letting everyone know the 10 equal weighted stocks that will make up each of our portfolios going forward for the next 90 days. So now's a good time to check out our service if you haven't already. Okay, let's take a look at what happened yesterday in the market. It just depends on which side of the market you were on. I mean, the Dow Jones had a pretty good day. S&P 500 tacked on more gains, actually 30, I think I may have said 32.47, actually 32.57. So we got about 25 points down to that 32, I think it's the 32.32 level. So almost 1%. So if the S&P 500 pulls back a bit, that's not really that big a deal. That was the June high right here that I was talking about, that 32.32 level. So we're above that now. Pulling back, that would just be the first line of defense. I mean, if we failed there, it wouldn't be that big a deal. But that would be one area that I would not be surprised if we pulled back, then the S&P found some buyers at that level. The NASDAQ, a new record high up near 11,000, but we did have a pretty big reversal. And that's the second one of these reversals now that we've seen in the last couple weeks. So, and both of them, by the way, if you look down to the volume, very, very large volume, reversing candles, filled red candles. That could be setting at least some short-term resistance. We might see a little bit more sideways consolidation in the NASDAQ in the near term. It's really going to come down to these earnings reports. I mean, we got some big ones, really biggies coming up tonight. We got Microsoft and Tesla. That will go a long way to telling us what the market thinks of earnings season, because I expect both of those companies to report very strong results. But has the market already built it in? If we get big reports out of Microsoft and Tesla and we can't break above these highs, then I think we've probably got a short-term top in play. So something to really pay attention to later when Microsoft and Tesla report after the bell today. Mid caps had a pretty good day. Small caps, best of all, up more than 2% yesterday and starting to strengthen again. So that's a good sign. That'll help the market. These two groups, by the way, if you look at the accumulation distribution, have been the weakest versus all of the major indices. So if we can start turning up there along with good price action and eventually make the breakout above the June highs, that just adds to the bullishness. That's more and more charts that are bullish. And if you look at the number of folks that use technicals in the market today versus 15, 20, 30 years ago, it's a much bigger crowd. And so when we start seeing more and more areas of the market breaking out, that's going to be more technical buyers coming in. It's really hard to think bear market when you've got almost every area of the market performing well. Now, energy led by a wide margin on Tuesday. Energy, the XLE up 6%. A huge day. It was the only index really that was weak, was so weak that it was trading below a 20-day moving average, which was trading below the 50-day moving average. If you look at the configuration on all the others, even financials and industrials, which have been relative laggards, on an absolute basis, they're fine. It's just that they're not keeping up with technology and communication services. As you can see, both of those making breakouts recently, and financials and industrials still not up to those June highs. So, like I said, we've got this bifurcated market, but most areas of the market remain very bullish on an absolute basis. So our job is just trying to be in the areas that are outperforming. Okay, let's take a look at the 10-year Treasury yield, get an update here and see where we are. Down below 0.6%. And this is part of the problem with the US dollar, and I'm going to get into that in just a minute. But the 10-year Treasury yield continues to move lower. And not only has it been moving lower, but when you look back here over the last, 6 weeks or so, it's really been moving lower versus the German 10-year Treasury yield. And that's really important when you're looking at the impact on the dollar. And then, in turn, the dollar's impact on the various areas of the market. So just keep this in mind. Right now, we're down a little bit. We do have a couple of economic reports coming out this morning. At 9 o'clock, we'll get the May FHFA House Price Index. That's expected to rise 0.4%, but it is, we're talking about looking in our rear view mirror. I mean, we start getting May economic reports. I mean, we're in July now. So kind of take the May reports with a grain of salt. There's not a whole lot that I don't think the market is going to really move too much on a report that's a couple months old like that, unless it is just completely, out of the ballpark and baffles everyone, which I don't expect. But that expected rise, 0.4%, would double April's rise of 0.2%. And then at 10 a.m., June existing home sales will be out. And the expectation there is for 4,800,000 units. And May's number was 3,910,000 units. So we're looking at about 900,000, probably about 22% increase from May to June in existing home sales. So that'll be a number to watch, certainly around 10 a.m. All right, let's move on. Talking technically, I really want to go over this dollar here. And just, if you look at this, this is a 3-year chart on the US dollar. And you can see during the pandemic, we had the huge drop, then we had the huge rise, and now we've come down and we are testing this low. I think this is a pretty important area. I mean, I could annotate this and I could draw support area a couple of different places. I mean, I could start here and just say, okay, anything from about 95.5 down to the low we saw in March You know, I could draw that as a support area. See this low here and all of these different lows. I mean, this takes us back about, I don't know, 20 months or so. And so we haven't been below 94.5 in the last 20 months. Now, if we wanted to stretch it, you know, maybe we could go all the way back to these lows and say, well, for over the last 2 years, we haven't gone below 93. Or, you know, maybe we go to there and say 93.5. You know, the point is you can keep going back further and further and further. But I'm really watching right in this area. I think this is pretty important for the dollar. And we are now into this zone. Is the dollar going to hold support? Now, why is that important? Well, it's important for a couple of reasons. But here's a chart of the 10-year Treasury yield, U.S. 10-year Treasury yield, minus the Germany's 10-year Treasury yield. So we're just taking the two yields and we're subtracting one from the other. When the Treasury yield in the U.S. is rising versus Germany, that is an indication that our economy is stronger. Our economy is stronger, at least it's viewed to be stronger than Germany's. When that's the case, the dollar generally is going to rise. Your dollar is going to get stronger when your economy is stronger. And remember, we're a global market. It's not just about our economy strengthening or being strong. It's really the relative strength of our economy to other economies. That's what dictates the strength or weakness in the currency. So here you can see dollar, there's no doubt in my mind when you look at this, and there's a correlation down here. You can see it's almost always positive. This is a pretty important chart to watch. So US Treasury yields were just soaring versus Germany, and the dollar went along with it. But we ran into this period here where things started to go a different direction. And this was a warning sign for the dollar. Here we had what I was highlighting were all of these inverse correlations. Anytime correlation went negative, you see that the last 3 times we saw it, the Treasury yields in the US were rising faster than Germany, but the dollar was going down. All 3 times that you see in these green shaded areas. And all 3 times the dollar came charging back. Well, I've written about this, several times probably over the last year and a half, but this was a warning sign. This was going the other way. The dollar kept going higher, but the yield versus Germany was coming down. So it's telling us that, maybe there's a slowing in the US economy relative to Germany. And so that means the dollar should go down, but the dollar was going up. And there's your inverse correlation down here. But what's happened now? Now the dollar's playing catch up. I'm really watching this area on the yield to see whether or not this sideways consolidation that we've been going through now for the last few months, is it going to stop and turn back to the upside, or is it going to break back down to the downside? If it breaks down and this trend line is lost, then I would say that the dollar bears are in charge. Until proven otherwise, you got to believe that the dollar is going to weaken. Could be a head fake, but I think when you see the trend line break, you've got to be ready to make some changes. So what would the dollar, what does the dollar mean? I mean, I wrote about, I think in my daily market report yesterday, I wrote a little bit about the materials group, energy. Those groups will benefit from a weaker dollar. They have been benefiting from the weaker dollar, especially materials. If you look at the XLB versus the S&P 500, ever since we topped on the dollar and been going down, XLB's been outperforming. So that's why this is big. Is our materials going to continue to outperform? I don't know, but I think the dollar will tip us off. The other thing that's big with the dollar is if you invest in international ETFs. Here I'm showing the EWG relative to the German DAX. So the EWG is an ETF that tracks the Germany iShares. And so the EWG and the DAX pretty much, they go hand in hand. However, there's a dollar component to the EWG that you don't have when you just look at the German DAX. And so when you're in a strong dollar environment, look at how the EWG underperforms the German DAX. But when you're in a weak US dollar environment, like we were from 2002 down to 2008, look at how the EWG outperforms the German DAX. So if this dollar breaks down and you want to have money invested internationally, the EWG, you win on 2 fronts. You win first because Germany's doing better than the US, but you win on the second front because the EWG will outperform when the dollar breaks down. Now, again, we haven't broken down. I think it's really important. A lot of folks are jumping into materials right now. If this breaks down, it's going to turn out to be a great move. If this trend line holds, it's going to turn out to be a horrible move. Because if this dollar starts to turn around and starts moving back higher, materials, energy are going to struggle on a relative basis. That's been the history. So just wanted to point that out. All right, let's move on. I want to get into chart lists and scans. This is really big as far as what we do over at Earnings Beats. And so first thing I wanted to do is pull up a chart on, pull up the summary of the strong AD chart list. So this is just yesterday's performance, and too bad we didn't own OMI. That was one I did own not too long ago. It is in the healthcare area. But anyway, stock was up 81% yesterday. That's a pretty nice return. But the point here is, how do we run scan? What do we do with, say, the strong AD? You got these chart lists over at Earnings Beats. We've got scans. So if you look over here at our scanning page, we have scanning strategies, and we have syntax that you can copy and paste over at Stock Charts to run scans against our chart list. And if you're at least an extra member over at Stock Charts, you can download our chart list right into your account. So like our strong AD chart list, also our, we got strong earnings, we got short squeeze, strong future earnings, raised guidance, strong AD, and weak AD. All 6 of these chart lists are available to download into your account. All you have to do is be an extra member and a member at Earnings Beats. And if you're both, even a trial member, you can take these chart lists and download them right into your account. But then once you get the chart lists into your account, you can then go into our scanning strategies, and you can take these scans and run scans against our chart list. So we do all the homework and the research for you in the chart lists, and then we give you some tools to actually find great trading candidates within those chart lists. So let me give you an example. I'm going to run, now I know the market's been going up, and when we think about RSI 40 to 50, it's a pullback scan, but not every stock goes up. Just because you see the market up and you think, wow, I don't want to get into the market now. The S&P is now at a new high for the year, and we took out that June high, and I can't get in now. Well, it's not up to a new high for the year. Forget about that. NASDAQ is. S&P isn't yet. But when you look at the overall market, not every stock is going up like the S&P 500. You have pockets of strength. You have pockets of weakness. Even the strongest stocks will pull back while the rest of the market keeps going higher. I mean, software finally had a little bit of a pullback, but the market kept going up. So you can run this scan. So what you can do is you can take this syntax and copy it, and then I can go over to Stock Charts and to the scanning page. Just go to New Scan, get rid of the default that they have in there, and just paste. So this is going to pull up all stocks that have an RSI from 40 to 50, greater than 40 and less than 50. Now, that's going to give you a lot of stocks because it's going to be every stock out there. I don't want to do it against every stock out there. I want to run this scan against one of our chart lists. So I'm going to run this against our strong AD chart list. So we add this. Now, there it is. And by the way, this right here, don't let this confuse you. This doesn't matter. We don't even need this on here. Anything after those 2 slashes is just for our information purposes. The scan engine doesn't do anything with that. So I can get rid of all that. Don't have to, but I can. Hit the check syntax. Okay, it says my syntax is good to go, and I run the scan. Now, when I run this scan, it's going to bring up in this chart list, the strong accumulation distribution chart list, the stocks that meet that criteria, RSI between 40 and 50. Look at this. I mean, we've got 59. I don't know. I mean, we've got 300 and let me see. We've got 369 stocks on the strong AD chart list right now. 59 of them have RSI between 40 and 50. That's a lot of stocks where you're not chasing. These are a lot of stocks that have shown great accumulation distribution throughout the pandemic, but have pulled back and provided some opportunities. Now, one thing you could do is sort it by scooter. So all of a sudden, you have one of the top scooter ranked stocks, one of the best relative strength stocks, and it's got a RSI between 40 and 50, which means it's been pulling back. So Veritone is going to be one that, obviously is going to, I want to see what's going on. And now you can see, look at this move the stock made and the consolidation. So by running the scan, it's not going to send you toward the stocks that have been exploding and going up day after day. Instead, you can find some stocks that have actually pulled back. Now, is Veritone going to go up from here? I don't know. I mean, it's up against that 20-day moving average. We might come back down one more time. But if this breaks through the 20-day, I could get in around 13 or so with recent highs up near 20. So if this turns out to be a big uptrend followed by a cup, or maybe it's just going to go up to 16. Maybe it'll be an inverse head and shoulder. Left shoulder, neckline, head. Maybe we go up to 16, 15, 16. If I'm playing it from 13, that still gives me a lot of upside. So, this scan, we could spend a few hours going through all the charts that are on this, that are returned with each of these scans. But I just want to, make you familiar, if you're a member at Earnings Beats and you maybe haven't tried this, how easy it is and how we set everything up for you to hopefully succeed in the market and have better trading candidates. Another scan that we can do, let me get rid of this. Let's go back over to the site, and now the market's been breaking out. So another test that we can run, why don't we try to run the 52-week high? I mean, we know we've got a lot that have been breaking out, but we also are breaking or pulling back, with the RSI 40-50, but we also know that there are going to be a lot that are breaking out. So I copy the syntax. Syntax is pretty easy, but it can be intimidating if you're not familiar with stock charts. That's why we put it on here. So you take that and you go back over to your scan and you paste it. So now I'm going to run a 52-week high scan. Now, what do I want to run this against? Well, let me show you another little trick. We've got two chart lists, the strong earnings chart list. So let me add that one. And then we've also got the strong future earnings chart list. So let's add that one. Now, if you're not familiar with these, strong earnings are companies that have beaten Wall Street estimates, top and bottom line. They're liquid. Their charts look good. They've got, nice relative strength, or they're, technically they look, pretty positive. And so they get added to the strong earnings chart list. Well, as they approach earnings season, we take them off. The strong future earnings picks up companies that have either come off of the strong earnings chart list because they're getting ready to report, or they also pick up companies that never were on the strong earnings chart list. In other words, Wall Street could be expecting company ABC to do really well, but they didn't do well last quarter. And as a result, they didn't beat and they didn't get on our chart list. So these two chart lists over at Earnings Beats are kind of similar, but they have no repeat stocks. They're completely different. So if I run the scan, 52-week highs that are part of this chart list and are part of this chart list, it's going to come back 0. And I'll show you. So check the syntax. We're good to go there. Run the scan. And I go back to the scan results, and there it is, 0. You think, wow, what's wrong with my scan? Well, there are no similar stocks on these two chart lists. So these two chart lists are never going to return anything like that. But here's a little trick. So let's put another bracket in here, and let's go down here and type in or, and then you got to remember to put another bracket at the end. So, and again, the wording and stuff here at the end, we don't really need. All right, And so let's check the syntax. We're good to go. Now it's going to pick up any 52-week high that is on this list or on this list. So it's looking at both lists, and it'll give you all the stocks that it finds. So let's run this scan. And now it's giving me 112 stocks between these two chart lists. Now, these two chart lists have a total of 514 charts. So this is roughly 20% that hit 52-week highs yesterday. Okay. Now, when the market opens, you can change this to the last intraday update. So you can run this scan or any scan using the current information. So if you wanted to check this and see which stocks are hitting 52-week highs at the open, you know, at say 9:35, just make sure that this is checked as last intraday update. All right. Now, again, we don't have time to go through all these different stocks, but you could sort it by scooter. And then, you know, a lot of these stocks at the top are going to be stocks that just keep going up and breaking out every day. So stocks that are just crazy bullish. But if you go down to say 90 or so, I'll pull up here, Nuance is 89.9, another software company. This one broke out, not yesterday, but the day before, out of sideways consolidation. So as a result, the scooter score wasn't too high to begin with. Okay. So those are just a few tips, you know, that you can use in trying to scan and find some stocks that you might like to trade. All right, let's move on into earnings. And for earnings, I want to just start off here with Texas Instruments, because Texas Instruments came out yesterday, did beat by a mile on the bottom line, $1.48 versus 88. And anybody who's been saying, oh, the S&P 500 earnings are not going to support this move, well, Texas Instruments beat $1.48 versus 88. Intuitive Surgical beat, how about $1.11 versus 34 cents? So yeah, if you're pricing the market off of what the S&P 500 consensus estimates were, then you might say, hey, this is nuts. But those consensus estimates were never any good. That's what Wall Street's been telling us all along. Many of these companies, look at Intuitive Surgical, up another $4 or $5 today. Look at the breakout after sideways consolidation. Broke out heading into earnings. Probably now that the news is out, maybe it'll pull back and you'll get another shot down around 600, 625. But this is a nice looking chart. Another company that reported was Snap. Little disappointment there. They only matched, and the stock is actually down a little bit, 23.21. So it looks like it's going to be opening below the 20-day, and that's been big. So does it come roaring back, or does it maybe make a run back down toward the 50-day? That will be an interesting stock to watch today. But not all the stocks came up, you know, smelling like roses. We had UAL. They missed on their earnings estimate. They were expected to have a loss of $9.13. They had a loss of $9.31. So as bad as that sounded, it actually came in a little worse. And there's a reason why airlines just cannot seem to get going at all. You know, like I said, the S&P just broke out. The airlines were one of the groups that were leading the S&P back in June when the S&P made that June run. They're not even part of it on this run. I think the airlines continue to be the weakest area. I would not own them. And on pops, I mean, if you're looking to short anything, to me, it's the airlines. All right. This morning, we got a report from Thermo Fisher, one of my favorite stocks going into earnings. They absolutely crushed the bottom line. 389 versus 267. So if you see, you know, a stock, you know, this was one of those stocks back in March going straight down, but AD line was going up. All these hollow candles, Thermo Fisher was being accumulated. It was being trashed at the open like everything else, but you had professionals buying the stock. Now we know why. Now the stock breaks out, trades up another $8 or whatever it was with its earnings. Strong, strong action. All right. I tell you what, for the three you must see, I'm going to pick three stocks that reported this morning. Market just opened. So let me see. I'll just analyze three of these companies. One that beat. So let me pick IQV. And we'll pull this up on a relative basis. All right, nice uptrend, a nice little cup, little sideways action. Looks to me like it's breaking out with increasing volume. They did beat 118 versus 105, so a nice beat. They're in the healthcare sector. They're a healthcare provider, and they've actually broken out to about a 5-month relative high to their peers before the earnings came out, and they just beat their earnings. So I would be looking for the stock to make a run up toward 165 to 170. And we're at 160 right now. But the problem is the reward to risk isn't there for the stock as far as a trade goes. Because yes, you have $5, maybe $10 to the upside, but where are you going to set your stop? I mean, at a minimum, I'd have to give it down to 155. So if I look at even at a 170 top, which is probably stretching it, that's 2 to 1, which is okay. But again, 155 is just right here in the middle. We're nowhere even near the 20-day. So this is a stock I really like, but I'd need to see it pull back a little bit. All right, let's take a look at RCI, Rogers Communication. This one actually missed its earnings. Look at the accumulation distribution on this one. See how weak it is? They came up 43 cents. The market was expecting 59 cents. Look at the relative strength. So this is Rogers Communication versus basically the wireless group versus the S&P. And then look at its peers relative to the S&P. Very weak group and a very weak stock within the group. Should we be shocked they just missed their earnings? I mean, this is the way the market works. You have to follow relative strength. Wall Street is got a lot of really smart people, and they've got a lot of insight into these companies with their analysts meeting with management throughout the quarter. And then the charts, forget about CNBC and what everybody is talking about. I don't care what they're talking about because that doesn't tell me what they're buying or selling. This chart tells me what's being bought and sold. RCI has been sold on a relative basis. Now we get the bad news. And look at the stock down 4%. No way would I have held this stock going into earnings looking at this. I don't like holding stocks into earnings anyway, but relative strength gives me a lot more information going into earnings. So you don't want to hold, at least I don't want to hold a stock that looks like this. All right, one more of the three you must see. Oh, I wanted to see Checkpoint. I haven't looked at this one yet, but I know it broke out recently. So let's look at, what is it, CHKP. Software company. But do you see the sideways consolidation and the recent breakout? They beat. So they came in $1.58 versus $1.42. Now, the last 30 days or so, we're starting to see relative strength in this stock versus software. It had been in a downtrend, but the last month it's been building up, and it's in a much stronger group. So even if it was, beaten up, excuse me, on a relative basis versus its peers, I'd still give it a little bit better chance than normal just because it's in a strong area. The market loves software. So with this move, we're getting the gap up. I think you could pull back. I think 124.5 or so. Let me see what that gap support is. 124.36. And then you've got your 20-day moving average all the way down at 117. When I look at a stock that's gapping up like this, I don't know what's going to happen right now. I don't trade. I will not jump into a trade at 5 minutes past the open that on a gap up, because the way I trade a gap depends on how the stock trades after the open. In other words, are we going to open at 129.63 and run to 140 today? And have this huge hollow candle? Because if so, 129.63 becomes a major support level to me. I don't look for 124.36 anymore. But most gaps fill. The ones that go from 130 to 140, that type of a candle, that's the minority. Because when you gap up, market makers see all the order flow. They know how many people are trying to buy this stock at the open. They are already setting. They look at the demand, supply, and they're setting the price, and they're taking the short position. When everybody wants to buy, you're not going to have as many sellers. You're going to get swamped. There's an imbalance. This is what market makers do. They cure the imbalance by moving into the position on the other side of the trade. They short. So if they're shorting at 130, chances are it's going to fill. Why? Because market makers don't lose money. I mean, they'll lose money on individual trades. Don't get me wrong. They don't make money every trade, but by and large, they're going to make money. And if you're a short-term trader, you want to be on the side of the market makers as often as possible. Now, I don't short in a secular bull market. I never have, never will. Being short and watching my money go down while the market goes up, for me, emotionally is the worst. That's the worst. That's when I will make emotional decisions. So I don't do it. I believe we're going higher in the market. I want to be on the long side. But I would look at this stock and say, okay, I'm in a good group, software. I've beaten on a relative basis for the past month or so, starting to show some good relative strength. Volume trends are supporting this position. But where would I want to enter? I don't want to enter at 130. Not now. Now, at the end of the day, if it gets to 140, like I said, then yes, 130 will become the. But if I get in here and it fills a gap, I'm down $6 right from the start. What if it goes below the gap? Sometimes they go all the way back down to the 20-day. I mean, if I buy at 130, I could be down 10% before I even hit the 20-day moving average. That's why we keep our chart lists, because we've got scans that we run to test for 20-day tests. We have scans, downtrend reversal scans. So a stock that's been going down for several days all of a sudden starts to turn back up. We have ways to pick up these stocks later when they're much more advantageous. So I just don't like chasing. I don't like making, to me, it's an emotional trade. You're looking at earnings, you're seeing a gap up and you say, oh, I want to get in. Many times that comes back to haunt you in the short term. Now, if this turns out to be the start of a major outperformance of checkpoint, it's not going to matter really whether you buy at 130, 140, 125, 117. I mean, if the stock goes to 200, you're going to make money. But I think it is important in terms of trying to get in at the best price possible. Anyway, I've spent a lot of time talking about this, but really we're going into earnings season, and this is our niche at Earnings Beats. Earnings, gaps, chart lists, doing our homework, research, running scans, and trying to find the best stocks to trade. Better timing, better trades. That's our slogan. All right, so that's it. Let's go ahead and wrap it up. Take a quick look, see what the market's doing. Right now, Dow up 23, S&P up 3, NASDAQ up 13. So not really a whole lot, close to the flat line. Did have some selling late in the day yesterday. I wouldn't be surprised to see if that, see that kick back in again a little bit. But we'll play it by ear as we go along. I'll be back later today with that daily market report for all of our members at Earnings Beats. And again, for those of you that are not members, you can sign up for our free newsletter or sign up for our service. We'd love to have you. Everybody have a great day. Be back tomorrow over at Stock Charts for your next episode of Trading Places Live. Take care, everybody. Happy trading.